So now we're on chapter 15, and I'm going to try to make it in the area of the same time, which was about 30 minutes, if not sooner. So let's go ahead and jump right into this. Section 1 of chapter 15 is planning adjusting on entries. And two objectives of this section are to prepare an unadjusted trial balance, and second one is to adjust supplies and prepaid insurance. Adjusting account balances. Some general ledger accounts need to be brought up to date before financial statements are prepared. Okay, this is more often than not, actually. Adjusting entries are used to bring a general ledger account up to date. Preparing an unadjusted trial balance. The first step in preparing adjusting entries is to prepare a trial balance. Vocabulary term here: unadjusted trial balance is a trial balance prepared before adjusting entries are posted. Preparing an unadjusted trial balance. Okay, these are the steps. First step, write the account titles. Second step, enter account balances. Third step is to add everything up to get a total, and then prove and rule. Slide. Okay. 3,983.17. Our supplies expense, and the supplies office is adjusted by that same amount. Okay, supplies expense for the store is that amount, and then the supplies for the store is adjusted in the opposite direction in the same amount. Okay, recording adjusting entries for supplies. First, debit supplies expense, and then you're going to credit the supplies expense. You could see that they are the same amount, just debit and credit. And then you're going to debit the supplies expense, and then you're going to credit the supplies store. Okay. T accounts, and then you have general journal. Okay, and this is for prepaid insurance. Prepaid insurance looks like it was 8,200, and it's adjusted in the insurance expense and then adjusted the other way in the prepaid insurance expense. So 8,200 is the insurance expense and prepaid insurance as mentioned in the general journal. So debit insurance expense and credit prepaid insurance. So review questions for first section of chapter 15. Which adjusting entry is unique to a corporation? Remember, corporations have the same legal rights as people, as human beings. Okay. Federal income tax expense is only for corporations. What four questions are used to analyze the adjustment of an account? And these were just mentioned a couple slides ago. So what's the balance of the account being adjusted? What should the balance be for this account? What must be done to correct the account balance? And what adjustment is made? Which accounts are used for the adjustment to office supplies? And these would be the expense and the normal. So it would look like supplies expense for the office, and then supplies for the office. Okay, last review question for the section. Which accounts are used for the adjustment to prepaid insurance? And this is those two: insurance expense and prepaid insurance. Okay, moving right along to the next part of the chapter. This is section 2, adjusting merchandise inventory and interest receivable. Okay, so here are the two main learning objectives. So the first two sections of this chapter are going to be relatively short, and then the remaining two sections of this chapter are going to be longer. At any rate, here are the two objectives. First is to adjust merchandise inventory, And then the next is to adjust interest. Here we have some vocabulary terms to get us started. Beginning inventory is the amount of inventory on hand at the start of a fiscal period. Okay, so now during this period, merchandise is bought and sold. Okay, comes in, comes out. To determine how much merchandise remains in inventory at the end of the period, a physical inventory is conducted. So that means that people are counting this, how many items they have. Might be robots these days who are programmed to do that. Ending inventory is the actual count of merchandise at the end of a fiscal period. Okay, so these are how some of the T accounts would look. And then you have the general ledger and the general journal. Okay. So the debit income summary is the first line, and the second line is the credit merchandise inventory. So we started with the number 5,648.44, and then we adjusted that in merchandise inventory, adjusted it again in the income summary. Okay, and then for the general journal at the bottom, we input that same number for income summary and merchandise inventory. Okay, going from debit to credit. Accrued interest income means interest that you've earned but you haven't collected or haven't received yet. So interest receivable is how it would look for the T account. That means debit increases, credit decreases. And interest income, the other T account that's associated with this, debit decreases, credit increases. Opposite of interest receivable as far as more T accounts, trial balance and general journal. Okay, interest income is adjusted $93, and that means the new balance is adjusted by $93. Okay, and then at the bottom, we see debit interest receivable for 93 and credit interest income for 93. Okay, so just two different lines, same information, just different terminology. Okay, that was a quick lesson as mentioned, but the other two will be a little bit longer. So review question, first one from section 2 of chapter 15. How is the amount of merchandise inventory on hand at the end of the fiscal year determined? And that's just a physical count. Physical inventory is conducted. What adjusting entry is recorded when the ending merchandise inventory is greater than the beginning value? And that'll be debit merchandise inventory and credit income summary. How often is revenue earned on an outstanding note receivable? That's daily. Last one for this section. What types of accounts are increased by recording an adjusting entry for accrued revenue? The adjusting entry for accrued revenue increases a revenue account, aka a credit, and increases a receivable account, also known as a debit. Okay, so now on to section 3 of chapter 15, where we're going to talk about something that we haven't talked much about this semester, but it's good to know and essential to accounting, and that's depreciation. Okay, so we'll talk about that in just a second. First, going to mention the two objectives of the section, and that's to calculate depreciation expense using the straight line method, and then to adjust the accumulated depreciation. Okay, category of assets. Most businesses use a lot of different types of categories of assets in their operation. So this could be machinery, equipment, intellectual capabilities, people, and so forth. Okay, Current assets are cash and other assets expected to be exchanged for cash or consumed within a year. Okay, so they're pretty liquid for the most part. Plant assets are physical assets that will be used for a number of years in operating business. Depreciation is a loss in the usefulness of a plant asset as a result of wear or obsolescence, which means something becoming obsolete or no longer working very well or is, appropriate. Okay, depreciation you might have heard from, let's say, a personal finance class when they talked about cars depreciating in value. That means the value is going down. So to match revenue with the expenses used to earn the revenue, the cost of a plant asset must be expensed over the asset's useful time. And that'll lead us to the depreciation expense, which is the portion of a plant's assets cost that is transferred to an expense account in each fiscal period during that asset's useful life. Useful life is how long it can be used for. 3 factors go into calculating the actual amount of depreciation expense for an asset of a plant, and that's the original cost or the face value of the cost that was paid for the item, the salvage value, that means how much it could be sold for, if anything, then the useful life, this is time, usually in years. Depreciating plant assets, the original cost, okay? So this would include all of the costs to make the asset usable to a business. So it would be the price of the asset, plus any delivery and any kind of installation costs, even taxes. Anything to get you the final price. Okay. Now we're on salvage value. Salvage value is an estimate of the amount that will be received for an asset when you're getting rid of it. So you could also think of this as residual value or scrap value. And since this resale value, as I'll call it, cannot be known when the asset is bought, it can only be estimated. Useful life is the period of time when an asset is helping a business make their business easier. It could be a delivery truck, for example. It could be a part of the machinery in the factory. Anyway, it's supposed to help business happening. The total amount of depreciation expense is distributed over the estimated useful life of a plant asset. Okay, and there are 2 factors that are affecting the useful life of a plant asset. They are physical depreciation and functional depreciation. So 2 main types of depreciation. First one is straight line, and then we'll talk about accumulated. So straight line depreciation is recording an equal amount of depreciation expense for a plant asset in each year of its useful life is called the straight line method of depreciation. So let's look at these numbers as an example. Original cost of something is $2,500, and we're estimating that there is going to be an estimated salvage value of $500. So we're going to subtract that $500 from the original cost of $2,500, and that'll give us the estimated total depreciation expense of $2,000. So in other words, we had to pay $2,000 to be able to use this. Okay, so we're going to take that from the first line and then move on to the second line. Estimated total depreciation expense is $2,000. Then we're going to divide that by the years of estimated useful life, which is 5. So 2,000 divided by 5 is going to give us $400 per year of depreciation expenses. So that'll give us the annual depreciation. Okay, now we're to that second type of depreciation, which is accumulated depreciation. So this is the total amount of depreciation expense that has been recorded since the purchase of a plant asset. Okay, so we have 20 times 2 accumulated depreciation expense, which will be 800. And then we have 20 times 3, which is depreciation expense of 400. And that'll equal 20 times 3 accumulated depreciation expense. Okay, so we have 20 times 2, okay, which is 400. 20 times 2, which is 800. Okay, 20 times 3, which is 400, and then we're going to add those together to get 1,200. Okay, book value. Maybe you've heard about book values in cars. Some of you might have heard of Kelley's Blue Book, which is the Blue Book value of used cars, new cars even. So, book value of a plant asset is the original cost of a plant asset minus accumulated depreciation. Okay, so if the original cost, let's look at this example, is $2,500 minus the accumulated depreciation of 1,200, you're going to be left with an ending book value, 20 times 3 book value of 1,300. Okay, so if, for example, you were looking at a car that was brand new at about $20,000, 3 years later, you could use some kind of accumulated depreciation expense to see that it might be in the area of, let's say, 12 to 14,000 3 years later. For example. But this is what a lot of people who are budgeting do when they are researching what kind of cars they'd like to. Okay, moving right along, journalizing the adjusting entry for accumulated depreciation. And now we have our T accounts. Okay, so depreciation expense, office equipment goes up $7,485, and that's going to be adjusted in the next T account. Okay, depreciation expense for the store equipment, 2 from the bottom is 9,830, and then it's going to be adjusted in the balance in the following T account. Okay, so we're going to flip on to the next section where they use that same 9,830 number, and we're going to look at the general journal now, and that's we're going to debit depreciation expense for office equipment and credit accumulated depreciation for office equipment. Okay, so that's what happened there. We're going to use those same numbers, 7,485 and 7,485. And now we're going to look back at the numbers that we were just looking at. That's where we get 9,830. And that's step 2. We're going to debit the depreciation expense for store equipment, and we're going to credit the accumulated depreciation for store equipment. Okay, review for this section of Chapter 15. What are 2 categories of assets? Those are current assets, which can be sold or liquidated within a year, and then there are plant assets, which you need for a little bit longer. What 3 factors are used to calculate a plant asset's annual depreciation expense? And that's the original cost, the face value of whatever you paid for it, the salvage value, which means how much money you could get for it if you decide to sell it, and the useful life in years, or another time element, but hopefully years, because that would be the easiest. What plant asset account does not have a contra account for accumulated depreciation? That's just land. Okay, that's just a fun FYI there. And how does an adjusting entry for accumulated depreciation affect the related plant asset account? And there would just be no change in this. Okay, now we're going to do the last section of Chapter 15, and this is calculating federal income tax. So, the objectives of this section are to post adjusting entries, adjust federal income tax payable, and prepare an adjusted trial balance. So this is an example of adjusting entries in the general journal and how that looks. This slide, posting adjusting entries, will look at the steps, the 3 steps over here. First, we're going to post the debit. Okay, so we just got to find the debit, and then we look at the same account title, and we find uncollectible accounts expense, and then we find the account in dark green, and we write down the exact same debit. Okay, and then we're going to look down at the second entry where it says allowance for uncollectible accounts in the credit of $2,384.10. Then we're going to find that account in green, and we're going to write that in the credit. And then we're going to write for the post-ref G15 for both of those. Okay. And then the third step is enter general ledger account numbers in the general journal. Okay. Calculating income before federal income taxes. So quick vocabulary term. Adjusted trial balance. This is a trial balance prepared after adjusting entries are posted. Now we've got calculating income before federal income taxes. Okay, and I'll just read through these 5 steps over here. Okay, so first, enter the account titles of all general ledger accounts. Second, enter the account balances of all accounts except federal income tax expense. Third, calculate the total account balances of income statement credit accounts. Include the account balance of income summary if the account has a credit balance. Calculate the total account balances of income statement debit accounts, excluding the balance of federal income tax expense. Include the account balance of income summary if the account has a debit balance. 5. Subtract the total of debits from the total of credits to calculate net income before federal income taxes. Okay, so we've got 1, 2, 3, 4, 5. Calculating federal income tax. So different tax rates are applied to different levels of income or net income. Okay, tax bracket is each tax rate and taxable income amount on one line of a tax table. Marginal tax rate is the tax rate associated with a tax bracket. Let's see what we have over here. Journalizing the adjusting entry for federal income tax payable. Okay, so we're going to go up by 3,622.40. We're going to go down by 3,622.40 in our federal income tax payable from our federal income tax expense. Sorry about that. Completing an adjusted trial balance. This is where we were. Okay, first we're going to enter the adjusted balance of federal income tax payable, and then we're going to update the balance of federal income tax expense. And we're going to total, add everything together, prove and rule the trial balance. Okay, so now we're at the end of the last section, at the end of the chapter, and we'll go through the review questions. So how does the trial balance serve as a checklist for preparing adjusting entries? So a company can look at each account to see if the account needs to be adjusted. In what order can the adjusting entries be journalized? They can be done by the order of accounts appearing in the trial balance, beginning with assets or which accounts are totaled to determine net income before federal income taxes. All income statement debit accounts excluding federal income tax expense and all income statement credit accounts. Question: what is the bracket minimum tax and marginal tax rate of the 25% tax bracket? And the bracket minimum tax is $7,500, and the marginal tax rate is 25%. Okay, so that's what you need to know for Chapter 15. Best of luck on the test. Please get in touch with me for any questions.